financial survival network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
This show is now brought to you by Miles Franklin. And when it comes to protecting your wealth, you know there's nothing better than gold and silver. That's what I'm buying. I hope you're doing the same. And once you make the decision to buy gold and silver, there's no better place than Miles Franklin. Look, they've been in business 22 years. And the reason I'm a customer is because when you buy, they ship. Go to milesfranklin.com or call them at 800-822-8080 to get a free quote. 1490 WGCH. This is Carrie Lutz. You're listening to the Financial Survival Network. If you've been watching the gold and silver action like I have, if you're concerned about where your mining shares are going and what's happening, are the gold and silver markets bubbles? Well, we've got another roundtable with Jordan Roy-Byrne and Jeb Handwerger to help get through the noise. Jordan, how are you today?
I'm pretty good. Thanks for having me on, Carrie. How are you?
Doing great. It's always a pleasure to have you on. Jeb, how are things?
Things are good. Thanks for having me.
It's great to have you both here because two heads are always better than one. So, Jeb, what's going on with these markets here? Is it intervention or is there fundamental market action taking place that we need to consider?
No, I think that we're going through a bottoming process, especially in the gold and silver miners. Since October, we've had a very powerful risk-on rally. And since that time, gold and silver have not kept pace with the industrial metals, and they have not kept pace with oil. The rise in oil, which is outperforming both European and U.S. equities, part of that premium is coming from the Middle East. So not only is it the risk on rally that we're seeing all this money that came in late 2011 finally hit, we're seeing a risk on rally, but we're also getting a premium on oil on top of that from the Middle East and the situation with Iran. So this rise in oil is putting some pressure on the gold mining producers, and that's why we're seeing the miners kind of hitting new lows recently. But we think that we're much closer to a bottom in the miners, much more upside in the miners, and very limited downside at this point, very oversold. And it's really creating a very interesting value opportunity for long-term gold mining investors.
And Jordan, what's your thought here? What's the explanation? Do you go along more or less with what Jeb said on that?
I actually would have to agree with almost 100% of what Jeb said. I think he makes a lot of excellent points. Oil, whenever we see oil go up, that's always bad for the miners because that's a cost input. So that's putting some pressure on the miners. And also, I mean, let's just go back to last year where we had the European sovereign debt crisis there kind of before the end of the year. And what happened before we got to the end of the year, I mean, I was looking at a lot of indicators for markets in general, not the precious metals, but I mean, equities and commodities and emerging markets. And a lot of the indicators were so oversold as far as sentiment and money flows that it told me that that these other markets are actually at a major bottom at the end of last year, that it was a significant bottom and the first significant bottom since 2008. So that told me, I mean, I was pretty bullish on these other markets coming into the year. I did expect gold stocks to perform with those other markets, but they haven't. And so, I mean, there's some people out there who are very skeptical of this rally, and I do think the S&P is probably, I mean, I think it's probably going to peak at 1,500 or thereabouts, but you know, the last time we talked, I just want to mention again, I mean, markets move and stock prices move based on earnings growth, and we've seen really great earnings growth in the conventional equities area. And you know, that can happen while the economy itself can not do as well. So I think the reason we're seeing a rally in stock prices is because we're, okay, if you don't think the economy is improving, that's fine. We can debate that, but you can't debate the fact that corporate profits have been rising, and therefore earnings growth has underpinned this rally in stock prices. And at the same time, you have to remember, if you look back to the end of last year, a lot of money flow indicators, sentiment indicators, technical indicators were all at oversold extremes. So I think that's why we have seen the market rally. Now, I don't want to take up all the time as far as gold stocks, so I'll just leave it there. Maybe we can get into gold stocks a little bit more on your next question.
Sure. And my next question, I'll throw it back to you, Jordan, is Apple, big news with their dividend purchase, stock share buyback plan. Do you think that has any effect on the miners with their willingness or their anxiousness to pay out dividends with all these record profits they're getting?
Well, impact on the mine, I don't really see it having an impact on the miners. I mean, I guess if you look at Apple itself, it can kind of be a metaphor for what's going on in the stock market versus the mining equities, because we're seeing a lot of money move into the market itself. And when the market is healthy, it gives people a reason to ignore the less conventional investments like precious metals. So what's going on in Apple, I think, is kind of a larger metaphor for what's going on in the mining equities. And as far as Apple, I don't know what valuation is. I know it's been growing fantastically, so it's not that overvalued as far as a price earnings ratio. But Apple comprises a big part of a lot of these market indexes, and I think at some point this year, Apple could. It hasn't quite gone parabolic yet, but it looks like it could be in the early phases of a parabolic move. And so if the stock continues to go parabolic, it's going to peak at some point this year. And then when it starts to come down, that's going to put a lot of pressure on the market indices themselves. So, I mean, as far as Apple, that's kind of my opinion. Now, as far as paying dividends, I think these large miners, I mean, you guys know, once you get so large, it's the law of numbers. I mean, it's difficult for some of these companies to find, a couple million ounces a year to replace their reserves and grow their production. It's just mathematically very difficult for that to happen. So the fact that they're taking their excess cash flows and giving them back to shareholders in the form of dividends, I think that's a very good sign for the large miners. And I think that's, I think that's going to attract some new investors to the market. Maybe not immediately, but perhaps in the next year or two.
Yeah, Jeb, so you think Apple has any direct or indirect impact on our mining stocks here?
Oh, I think Apple has a big impact, and what we're witnessing is this valuation in Apple. People are concerned about a gold bubble. Well, if you look over the past 10 years and you take a chart of gold and you put Apple next to it, you'll see that the move in gold has been a much linear move, while this move in Apple is really getting to a point of irrational exuberance, which we have seen so much in the past, where it's no longer, is it going to be $500? Is it going to be $1,000? When's Apple going to be $10,000? And that mentality is a little bit dangerous if you study market history. Although Apple's had phenomenal growth and it's really leading the market, I would be concerned for investors that we're almost seeing a bubble right now in these Pandora and Facebook and Apple, and I'm not so convinced fundamentally that the rally, although we've seen this powerful risk on rally, I'm not sure 100% if it's really based on earnings or if it's based on all this liquidity that's been pumped over the past few months. And one of the things that's concerned me about this rally is the low volume. We usually with these rallies, you would see a very, if it really was based on real fundamentals and earnings growth, I would expect to see a lot more interest and participation. But it's been a very low volume rally. And recently we begin to see that the decliners beginning to outpace advancers. So it really hasn't been as broad a based rally as what you should be looking in a real healthy rally. So once we start seeing some of this capital flowing out of the equities, I think that it's going to look for quality and the real hedge against inflation, which is precious metals, which we see right now is at a really undervalued point.
Yeah, and so that leads to the next question, which is, how do you position yourself for what I think the three of us agree is an inevitable rally in precious metals and in the stocks? And Jeb, what do you think?
Well, right now I think the S&P is a little bit overvalued, and we've had a really powerful rally, and we should expect a pullback after such a powerful rally. Gold and silver has really been in consolidation mode since gold hit 1900, and silver has been in consolidation since last end of April when it hit close to $50. And these periods of basing or consolidations in the gold and silver market have always been, over the past 10 years, have been excellent buying opportunities. And you have to be patient as a gold and silver investor. I mean, look back just recently with gold, but when it hit $1,000 in, I think it was March of 2008, it didn't eventually break out for a year and a half later till about September of 2009. And then we saw a very powerful move from about $1,000 to $1,900 gold. Silver the same way. I mean, in March 2008, it didn't really break out again until August of 2010, where it created this basing period and kind of was ignored by investors. But once investors begin returning to gold and silver, the moves are quite powerful.
Yeah, Jordan, and what can you add to that? I mean, we're obviously at a base, a consolidation point. It doesn't look like the moves down are, at this point, very violent. It's kind of smoothing out, and maybe we're going to go into a pennant formation. What's your thoughts there?
Well, I think as far as the metals are definitely in consolidation. I don't expect that in the metals and the mining equities, I don't expect we're going to make new lows. Well, especially in the metals, because if you look at, for example, look at a chart right now, gold, very strong rally from almost 1550 to 1800. I mean, there's good support there at the December low. I think we're going to go a little bit lower, but I don't think we're going to make a new low, and that's really what's significant. I feel the same way in silver. Now, the large miners have broken to new lows. However, most of the rest of the sector, like if you look at the CDNX, which comprises mostly juniors in Canada, that actually made a double bottom late last year. So that's not threatening to break to new lows. And also GDXJ, even though it is a junior ETF, a lot of those companies are not juniors anymore. They're much bigger. But that hasn't made a new low yet. That could possibly make a double bottom. So Jeb said bottoming process at the very beginning of our discussion, and that's actually what I told subscribers in the last couple of days. I feel we're kind of entering into a bottoming process, and it's going to be, I don't think everything is going to bottom on one day. Some equities may have already bottomed a couple of days ago. I think the metals, it may take another couple weeks for them to bottom. We might see some stocks might not bottom for another month or two. So in other words, I'm kind of looking for a staggered type bottoming process. And I'll just mention one indicator I'm looking at. It's called the bullish percent index for the GDM index, which is actually tracked by the GDX. Now this is a percentage figure, so it goes from 0 to 100%, which tells you what percentage of the stocks in that index, and I believe there's about 30, so it's kind of a broad index, which percentage of those stocks are on a buy signal on the point and figure chart. Now, if you go back to the end of December, I think this bottomed at about 10%. Off the top of my head, I can't remember what this indicator, what position it was at in late 2008, but I think it was around 0% or 10% thereabouts at the bottom. Now, as of yesterday, it was 24%. Now, I'm looking at a lot of these charts, and if we could just see a little bit more weakness, I think that 24% would come down to 15% or perhaps even lower. So that's an indicator I'm looking at. I want to see that kind of get down to 10 or 15% to tell me that we're days away from a bottom as far as the indexes.
So it's kind of a contrarian indicator then, huh?
Right, it is. And so it's not, it's not to say that the indicator has to come down to 10% or so to call a bottom, but as far as risk reward, when the more oversold the sector is, the more the better the risk reward potential for us who invest on the long side. So that's something I'm really looking at. At 24%, it's definitely oversold. But like I told you the last time we talked, you really want to see extreme oversold conditions in this sector. Because if you just buy something when it's oversold, it could fall another 15 or 20% easily. You have to wait until something gets it reaches an extreme oversold condition, and you can look on the chart and say, okay, well, it's extremely oversold, and I also see that it's very, very close to a point where there was strong buying in the past. So that's as far as trying to nail the bottom, those are things that I look for.
Jeb, as far as picking a bottom and then acting on it, what advice do you have for that?
Well, I think that what we saw recently with the miners, like even a couple of days ago, it hit a new low and then it reversed higher. We're beginning to see some of that occurring. So what I'd be looking right now in the large miners is to see if this new low is in fact a fake out. And we've seen this occur a lot in 2011. What I want investors, and especially precious metals investors, to understand, especially about the gold mining stocks. If you take a look at the HUI, it's very common to hear, the miners have not kept up pace with the underlying gold metal. But if you take a long-term chart of the miners over the past 10 years, you'll see that the miners have outperformed over the long term the metal. And the gold mining index is up almost 3 times since the lows in late 2008. So what we're seeing in 2011, 2012 is an opportunity, this divergence between where we've seen the miners pull back a little bit more aggressively than gold is actually providing a great opportunity for long-term investors who understand that the gold miners really, over the long term, are the place to be.
Yeah, so you need patience and you need money and emotions and nerves of steel. So anything else in summing up where we should be? What's going to be the sign that really tips everybody off that game change, it's time, the trend has changed, it's time to jump back in? Jordan?
Well, actually, one quick point I want to make, which I made to my subscribers a couple days ago, and we've talked about the composition of these indexes, Kerry, is if you actually look at Goldcorp, Newmont, and Barrick, those 3 stocks comprise about 42% of both the HUI and the GDX. Now, if you look at a 1-year chart of those, you'll notice that they have very strong support. So these stocks, the downside for these 3 stocks, which make up most of these indexes, the downside is very, very limited in these names. Now, we see GDX and the HUI, it's down again today. Well, one reason, which I just noticed, is Randgold Resources is down 12% today. So that's obfuscating what's going on in the rest of the index. Maybe the rest of the index is, just down marginally, and then you have this one stock which is completely negatively impacting the index. So these are, as far as day-to-day movements, these are things you have to consider. As far as what's going to tip people or tip sentiment so it becomes more favorable, I don't see that happening for a while, honestly, because we have a lot of technical damage from the last year. I do think the sector is going to make a bottom, and I think for most of the rest of the year, we're probably going to have to really slog our way back up towards resistance. And I think, maybe at the end of this year, or early next year, these markets can break out and make new highs. And I think at that point, that's when you're going to see sentiment really get favorably bullish, not extremely bullish, but when sentiment is going to start to, kind of move from a low point to neutral, and people are going to get more positive and they're going to want to put more money into this sector. And at the same time, that is going to coincide with bonds, which appear to have already peaked. It's going to coincide with bonds in a negative state. Then if we have the stock market peak, and I don't think it's going to roll over completely, but if the stock market just peaks and it stops making new highs, then you have conventional investments not doing as well. And I think that's the environment which is very favorable for precious metals.
And so it's probably a few months ahead, but it's definitely coming. So anyway, guys, it's been great having you on here. Jordan, just tell us where we find you, where your site is.
thedailygold.com.
All right. And Jeb, where are you?
goldstocktrades.com.
All right. And if anybody has a question for either of them, you can always send it to me, kl@kerrylutz.com. I'll be more than happy to forward it off or discuss it with either of them during our next interview, which probably won't be that much further into the future, probably sometime in April. Thanks so much, guys, for being on here, and I hope your words have settled people's nerves a bit and given them a better understanding of what's going on in these markets. Jordan.
Thanks, Kerry.
Jeb, thanks.
Thank you, Kerry.
All right, guys, we'll talk to you soon.